Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing LVMH stock. They just reported earnings. The stock fell, I think, a little bit more even than it's showing up on the screen here. And I've had some requests. For this one, I did from both on the Full Cyclical Investors Club and here. I've had some questions about it, so I thought it would be a good time to take a look and tell you what I think. I'll share the buy price that I'm looking at. I did previously cover this one over on Patreon. If you want to check out those Patreon links down in the description, I have a free tier there. Usually I'm probably going to post a video like this on the free tier over there, but I thought I'd just put this one out on YouTube since it just came out. They just came out with earnings. As always, this is not individual investing advice. This is just how I analyze stocks. All right, so let's look at what they do here. Usually I look at earnings first, but we'll get just an overview real quick from the good old AI. So prestigious brands, leather goods, Louis Vuitton, right? And then wines and spirits, Dom Perignon, Hennessy, perfumes. I don't wear perfume, so I don't know very many of those. But then we have some watch brands. Tiffany jumps out at me, and then Sephora, which you probably see if you're go out in like areas where they have like luxury stores and things like that. Looks like they even have some hotels here, but the main thing I think is going to be fashion and leather goods. So kind of more expensive, kind of luxury goods, basically. All right. So first thing we'll look at are the long-term earnings. I am looking at the US ADR here. So this will be in US dollars and off the US exchange. On Fast Graphs, you can actually go and look at the Paris exchange. I think Paris is where it's at, I assume, and get the data from there too if you have the international add-on, which I do. Sometimes people ask me, I do have an affiliate link for Fast Graphs down in the description for 25% off if you want to try it. And some people ask me what kind of tier I'm using. I use the basic level with the international add-ons, precisely because sometimes you can go and get further data like that goes back farther. This one has a full 20 years, but sometimes the ADRs come out, just within the past 10 years or something. But you can go on the home exchange and get the same data from Fast Graphs and you can change the currencies. You can do all kinds of stuff. So that's been real handy for me. It used to take a lot of work for me to try to do all the earnings calculations and stuff for international stocks. I don't usually buy anything off international exchanges except for maybe Canada. So usually I use the ADRs, but having the data from the original exchanges can be really useful doing the type of analysis. Sometimes I even track them in my Google spreadsheet off the home exchange. So it's kind of tricky and a pain to do it, but it can be done. I have a couple of them that I do that with. Even though if I ever buy it, I'll use the ADR. So just a little background on that. All right. So let's look at the earnings kind of pattern here. And let's go back we'll go pre-pandemic. There we go. All right. So we go back to the Great Recession. We have only a 15% EPS decline over 2 years. That's pretty decent, actually. I'm not sure what I think the basic earnings are pretty similar for these guys. Yeah, the patterns are pretty similar. This is probably some kind of acquisition here. So yeah, small decline, but we don't really have a ton of earnings growth during this time period either. Even if we go up and include these kind of heavy growth years, you're looking at 10% earnings growth over this time period before the pandemic when things got totally wonky. Now, we did have interest rates very low, and that probably helped with some of these last few years. But I think 10% growth is reasonable here to assume. I'm actually going to assume 13% growth. Important to remember is inflation. We need to kind of think inflation during this period was very low. So if you take 10.5% growth and then you have an extra 3% inflation that we didn't have during this period, then now we're up to 13. So I think the 13 number works, and I can show you how I calculated that here in a second. But the earnings are not super cyclical. The sentiment around the stock is very cyclical. And if we look right now, and I mean that expressed by the stock price, relative to the earnings movements, it's down, and it's down a little bit today. So it's approaching like 50% off its highs. I think it's at 108. It peaked at 200. So yeah, we're almost 50% off the high prices. If we compare the peak PE here, let's see if I can get it pulled up maybe somewhere. Trying to. It looks like, 31. Back here it was about 32. So the peak PE before the great financial crisis and before this current downturn are about the same. So that can allow us to at least go back and look what happened there to give us an idea of what might happen, right, in the future. We also saw a decline here, even though earnings were rising 30%. So just sentiment alone can send the stock down 30% in recently. So you can take all the acquisitions, all the other things that they've done since then and get a more recent read on this before the current decline when earnings actually fell, right? So we know, and I bet this is like a 30, yeah. So in the similar type of peak PE situation, that's just change in sentiment, maybe forecasting, looking for investors getting jittery. So I think sometimes I run across people who have the assumption, well, they sell goods to rich people, and so rich people aren't going to be really hurt in a recession the same way that other people who aren't rich will. And so maybe they'll be defensive. The stock might be a good place to go because they aren't going out of business. There's always going to be rich people that's going to be buying their stuff. I do see that attitude a lot, not just with this stock, but with other luxury goods. So it can be really useful to just go back and see if that's true. So we have one example here where it's probably not true with a 30% decline, not related to earnings. But what's interesting is if you go back to the Great Recession, right, and you've had that attitude, it was down almost 80%. Yeah, so peaked at $50, troughed at almost 10. So that's almost an 80% stock price decline. Earnings only fell 15%. And it started at the same PE that it started this decline at. Those are the type of things where it's really handy to be able to go back and look at the history, and it's numbers compared to stories, right? The story does make sense. Like, oh, rich people always can buy expensive stuff. But it doesn't mean they will, I guess. And there's always going to be the aspirational buyer too, I think, on the edge. But you can look at the earnings declines, 15% decline. Now, we were also coming off probably a boom period here, especially with all the U.S. stimulus and everything that got put into the economy, along with low interest rates and all that stuff, where it could be a deeper decline. And guess what? We already see it's a deeper decline. They've already had earnings fall more than they fell during the Great Recession. So, the evidence is kind of here. There's not really too much. I don't think there should be a whole lot of debate about those issues, kind of debunking that idea, that it's, impervious. Now, the idea that they'll survive, they don't really have much debt, I don't think, and they have like a awesome credit rating. I think the CEO or maybe the primary shareholder is one of the more richer people in the world. So they're going to have access, to the means to get through any kind of problem that they'll have, right? Economically, I'm talking about. But getting through something doesn't mean investors will get good returns, right? If you pay too much. So if you paid, I'm not even going to pick the peak. I'll just pick kind of a little below it. So we'll do 10 years to 2018. May 2018 to May 2018. I'm just kind of somewhat randomly picking it. So we have a pretty good peak here, right? I'm not like just picking bad spots. So they only got a 9% annual return for a decade, right? That's not great, right? That's not a great return. So, and the stock, and I didn't pick one of these troughs. I could have made it look bad and said, oh, on this situation, you would have gone 8 years with basically no real return. And then, so you have to ask yourself, how long would you really hang on to that stock during that time, right? How patient would you really be? That's why you try not to pay too much for stocks when they're up like this, when they're trading at pretty high levels. Okay, so with all that said, let's get into, so what I'm going to do, I just want to make sure that was still up. I'm going to look back here. You can see it traded down to like below an 8 PE here on an absolute basis. I think I have it down at like an 8 PE in my spreadsheet for recession PE to see like what it did during this past recession. Usually I use like peak earnings and trough price. Oh, it actually did fall more than 80% if you use the trough. I don't know if I use this number or this one in my analysis, but it's going to be pretty close. So if the stock price fell 80%, but we kind of want to know what it was relative to these peak earnings this time around. Although you could probably just look at it and say, oh, well, if it had a similar PE that time and a similar PE this time, it could fall 80%. So I'll just try to buy it down when it's near 80% off its highs, or 75 or 70, you know. That might be a decent strategy. Sometimes I do that. That's for my deep cyclical strategy. But since their earnings haven't really been cyclical in the past, I like to use this recession PE approach instead. So I look at kind of what the recession PE was here. I say, okay, we have these peak earnings at $6.70. How far could the stock price fall in relation to those peak earnings? So the good part about that is if earnings do get horrible, I'm still sticking with my peak here, even though it was a little bit of a bubble. It wasn't too horrible. And so when the market gets really negative and things look really bad and the forecasts are horrible, I'm actually still looking back here at when they were good, and I'm assuming eventually they'll recover. I don't know how long it will be. I'm just going to try to buy it cheap. I know it's a quality business, and then I'll wait. So that's the difference between buying down here somewhere. I didn't pick the exact bottom, where after, 2 or 3 years, you're up 150%. Yeah, then if you want to hold for the long term and say, okay, this is long, so, or maybe take profits in half and hold the rest of the half long term. I've been doing that a few times. You can get good long-term returns pretty easily with not a lot of work once you kind of get them in the portfolio. So to figure out when to buy it, now if I use my standard earnings analysis and I assume 13% earnings growth, which is what they've done like the past 10 years, if you include these drawdowns here, I get about 13%. Let's see what Fast Graphs gets. Almost the same. Yeah, so we're in the same ballpark. This assumes kind of wherever earnings are now, which is $5.53 a share. They might go lower after this earnings report. I don't know. If they grow at 13% for 10 years, you can look at a business owner's earnings CAGR of about 7.53%. Again, this might be a little higher if we have inflation. But what I would say is the level that I'm aiming for here is 8%. So as the stock price goes down, your returns go up, your expected returns go up, assuming all the other assumptions are the same. So about $100 a share is where it would cross that level. But you would have to be willing to hold through an additional drawdown if the stock behaves like it did during the last recession. So you could get a good return kind of using that. And there'll be mean reversion probably on top of this if it goes from, I don't know what the PE is now, but we can look at it. I mean, if it goes from a 20 PE to a 30 PE like it traded at, up here, then that's a 50% gain, and then you get 8% a year on top of that, right? That's kind of how you could think of it if you wanted to. You can use the Fast Graph tool too, actually. So where are we at here? Yeah, 15. So they've averaged 25. So not as awesome as I thought. But if earnings recover, let's look just 2 years forward, 2.5. If we go from where the price is now, a couple years, to a 25 PE, you get a 50% return right off the bat. And then if the PE stays around 25 and you get 13% earnings growth, then you would get another, in theory, you would get another 13% a year after that, right? Now, theory doesn't always play out when it comes to market sentiment. But what I would say is, one, I wouldn't, if a person wanted to start buying in there, that's fine. But I'm pretty negative on the economy and recession and everything else around the world. So when I look at a recession buy price, it's down closer to like $74 a share, about 32% lower than where it is now. And that's where I would be buying, unless my attitude changed about the economy and things like that and the outlook. So, I mean, 30% decline from here isn't very far, really. I mean, we aren't even in a recession technically yet. And I think we're going to see a lot of spending freezes and things like that. These sort of tariffs and things affect businesses, right? And the people that are successful and are buying these luxury goods, a lot of them are probably going to be business owners, and they're just going to look around and wait. I mean, nobody knows how this is all going to affect all these businesses and business owners yet. So I think a 30% decline from here is, I mean, I'm not predicting it's going to happen, but I think if we have a recession, we've seen in the past that it could. Now, I should say this is not the recession actual low PE. When I do this process, I add 40% to that. So the low PE I have was like, for the recession, was like 8. And I add 40% to that. So I'm actually not waiting for the bottom that could happen. I'm saying let's get it within close to there, where I'm not buying too soon or paying too much and gives me a little bit margin of safety. But I'm not trying to be greedy and say, oh, it's going to fall exactly 80% again, right? So it's that looks like a low price potentially to people who, I don't know, now that people have seen how fast the stock fell 60%, or what did it fall? What did I say? Maybe not 60%, 50? Yeah, it's fallen almost 50% already. So it's not crazy to think it could fall from this point another 30% based on the past. All right, so that's my thoughts on LVMH. I'm watching it. I definitely would be a buyer if it hit that price. I'd probably take a full position too. I like strong businesses that you might have to be a little patient on, but you kind of have confidence that you can get through at a good price, right? So thanks for watching. Hit the like and subscribe button. If you have a request, put it down in the comments. I'll get it on the board behind me. Sometimes if I have something more interesting, I'll do it instead. But when I look and I don't have anything pressing, I look up on the board, see what people have asked for, and I make videos for them. And make sure to check out Patreon. I have weekly picks over there for $25 a month. Later.